Hi, I'm Peter Grant, and this is my very first attempt ever to do a market update by video. So fingers crossed the technology all works and we can get it done. The first thing I'd like to show you is the investor dashboard, and I find this a very useful way to just get a snapshot handle on what's happening overall and all the things that impact on property. So the first line is to do with the economy, and unemployment has fallen again, this time to 5.1%. GDP is at 2.6%, which according to the IMF is good, and consumer confidence is high. On the banking side, base rates remain at 0.5%, and there is some speculation that interest rates could actually go down. There's not too much chat about them going up anywhere near in the short term or the medium term. So that's pretty positive. Cost of money being low is a good thing. And the other aspects to do with the volume of mortgages and the type of mortgages are both in the increase again as well. So that means that the banks are basically recovering and going back to kind of where they were before the financial crisis. And both of those things then have a positive impact on property prices. So the latest stats we've got from Halifax show a year-on-year growth of just under 10%, which is great. They tend to fluctuate somewhere between 5 and 12%, depending on the month and whose index you look at. But Halifax are probably the most aligned to what we do and where we are. We know ourselves that the number of buyers that there are for every property when we go out and try and buy them for investors is very high. So there is an upward pressure on prices because of that activity. And price outlook through the RICS, being the latest survey from a couple of days ago, again is very, very positive. If we look at the headlines, then they too are pretty positive. So the sentiment remains very positive around property and buy-to-let. What I'd like to do is to just spend a few minutes answering some client questions. They're the ones we get asked most frequently, so why not share them with everyone? The first one is how property compares as investment to other asset classes. And this was an article in the Daily Telegraph which kind of acts as good a guide as anything else. And so the average performance of property has been much, much higher than the performance of pretty much any other asset class, whether it's commercial property, whether it's government bonds, whether it's cash or stocks for that matter. So as an asset class, it does fantastically well. We actually outperform the average, but this is a good independent comparison, as it were. What causes prices to move? Well, in fairness, the only thing that really causes prices to move in property is supply and demand. You can get all sorts of different shocks or events, so whether it's a recession or whether it's 9/11 or a referendum or dot-com bubble, whatever, you can plot these all in the graphs going back in time, and this graph shows property in the stock market only at one particular point per year. But what it shows is that property is a really rock-solid performer, and I've really come to the conclusion that the only thing that drives property prices is supply and demand. So in the UK, where there's a shortage of housing and there's high demand that seems to be growing ever higher, then there is definitely an upward continuing pressure on house prices, which apparently in turn is really good for the economy as well. So 3 points. One is that there's a housing supply shortage, means rising property prices and rising rents. Second point made again by one of our clients is that UK property is actually very much a safe haven. It's a very regulated area, and there's very low volatility, there's very low risk. So as an asset class, it performs really well, but it also has low risk. And the third aspect is that it's really easy to understand. So whether you own a house or you live in a house or you rent a house, you are living and understanding what's happening in the dynamic. So that's another good thing on property in my view. So what's happening in the market right now? Well, we get asked that pretty much daily, if you can imagine, because clients, sort of when they're thinking about investing again, really want to see what's happening. So we have got buyers who are out sourcing properties in all the cities every single day of the week. And and we consider everything that that comes onto the market, on and off the market in a given city. So we've pulled some stats together, and you can see that the ones that we consider and the ones that we offer on, and then the ones we get, there is a bit of competition going on there. We don't go for 10 and get 10, nothing like that at all. We tend to find that on average it's 1 or perhaps 2 in 10 that we're able to get by putting our best foot forward. So it's a very competitive market. And there's probably a few things that come out of it. The first one is that if you take cities like Edinburgh, Glasgow, or for that matter, Nottingham, we're typically competing against 10 or even 20 other people to buy an individual property. So the competition is very, very high, and our buyers do a fantastic job to secure what they can. Other cities then have a shortage of supply, and in Stirling's case, it's an extreme shortage of supply. So there is just no stock coming on, end of story. So in those cities, when one comes up, then grab it with both hands is the bottom line. And the other interesting fact is really to do with Aberdeen. And Aberdeen is obviously the oil capital of Europe. Oil prices being very, very low at the moment, Aberdeen is doing less well as a city right now. But what we're finding is that the competition level, so when we're bidding for properties, that's now increasing. So there is more activity, which would suggest that this might be kind of a good time to get into Aberdeen. So it's one worth having on your radar, as it were, especially if you're familiar with Aberdeen and comfortable with Aberdeen. What are our tips from banks? Question number 3. Well, I guess property, which is the blue bit of the graph there, that's ungeared, so let's say £250,000 of cash, with average appreciation of 7% per annum, which is the long-term average, then roughly speaking, the value of the property will double in 8 to 10 years. That's the rough benchmark that seems to be the 30-year trend in the background, as it were. However, if you get that £250,000 of cash and then you gear it up, then clearly you're able to buy perhaps 3 or 4 properties rather than just 1 in cash. And the impact therefore on performance is fairly high. So the benefits of gearing are that you basically can buy, as I say, 3 or perhaps even 4 versus 1 in cash. Cost of money at the moment is very, very low. And if I compare it to before 2007, cost of money was typically 7 or 8%. So cost of money, even from an expensive, or what you consider to be an expensive bank today, is much, much less than it was before 2007. There are some tax changes coming in from 2021. I'm not a tax expert, I'm not going to explain them in full, but I do understand the bottom line. And what I'm told from, and we've got models to help clients with this, is that you should really be aiming for a 60% LTV by kind of 2021. So if you're buying one today and you're keen on gearing and you gear 70 or 75% LTV, then it will, of its own natural accord through house price growth, more than likely be down well below 60% LTV by 2021. So that's the easy answer, the bottom line answer. If you're buying just now, then it's smartest to buy in cash and then put funding in at stage 2 if you can afford to do so, because where the seller has got lots of offers coming in, they more often than not will favour and put favour on someone's offer if it is in cash. So if we can buy in cash and then put funding in step 2, then that is the smart thing to do in the current market. Bank selection is really critical. We can point you in the direction of a couple of banks that our clients are very happy with. Equally, if you've got another bank who you find is a good bank, then let us know, we can share that as well. But make sure you run with not just one, but with 1 and plus the 2 that we would recommend as well, and then you've got choices. So to summarise all of that, the indicators are all really positive. So whether it's the economy, whether it's the banking and the state of the banks, whether it's housing or whether it's headlines, they're all absolutely heading in the right direction, no question about it. Property is considered to be a safe haven, so great asset class to be in, as well as for the purposes of the returns. And it has outperformed pension and shares over pretty much any period as an investment. And interesting to note that our larger, more sophisticated clients are all pretty much active at the moment. So it is a great time in the cycle to invest, there's no question about it. And the final thing I'd like to leave you is just our top 5 tips. We get asked this all the time by clients, so I thought it was just worth sharing with you. First of all, tip number 1 would be absolutely buying the right location. Don't get that wrong and buying a secondary location, buying a primary location, one where it's easy to rent, and that is the core foundation to get right in investing in property. The second issue or tip is traditional property outperforms others, so new build and so on, mainly because it's in better locations, but also its rentability and the price per square metre you're paying for it. It goes without saying that you want to buy at a good price, and that's what we're here to try and help you do, so you're not paying too much for something. Gearing is a benefit and improves performance, so that would be in amongst the tips to make your investment work. And the final one is really experience, and what we can give to clients is all the experience we've accumulated over 20 years and helping people invest over 2,000 times. So we should be able to save clients time and money. Thank you very much indeed.